preparing for a Performance Attribution Analyst interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a Performance Attribution Analyst do? A Performance Attribution Analyst explains why a portfolio outperformed or underperformed its benchmark. I would start by reconciling total portfolio and benchmark returns, then decompose active return into drivers such as allocation, security selection, currency, duration, curve, spread, or factor exposure. The job is not just producing reports. It is validating data, interpreting results, and giving portfolio managers credible insight they can act on daily. While answering, focus on the analyst's purpose, explaining active return, reconciling performance, validating data, communicating drivers to portfolio managers, and linking attribution results to investment decisions and client reporting. Question 2. Can you explain the Brinson attribution model? Brinson attribution separates active return into allocation, selection, and sometimes interaction effects. Allocation measures whether overweighting stronger segments helped. Selection measures whether securities within a segment beat that segment's benchmark. Interaction captures the combined effect of active weights and relative returns. For example, being overweight technology helps allocation if tech beats the broad index, while owning the best tech names creates selection value. It is most common in equity attribution. Make sure to cover the Brinson framework, including allocation, selection, and interaction effects. Use a simple sector example and clarify that the model is most common for equity portfolios. Question 3. What is the difference between arithmetic and geometric attribution? Arithmetic attribution explains period active return in simple percentage point terms, so it is intuitive for monthly reporting. The weakness is that effects do not naturally compound across time. Geometric attribution works with relative returns and links more consistently across periods, which matters for quarterly or annual explanations. In practice, I would check the firm's standard, ensure attribution effects reconcile to active return, and use a smoothing or linking method when needed. In your answer, compare arithmetic and geometric attribution, especially how effects reconcile over one period versus multiple periods. Mention compounding, linking methods, interpretability, and consistency with official reporting standards. Question 4. How can a portfolio have positive security selection but still underperform its benchmark? If selection is positive but the portfolio underperforms, I would look at allocation, currency, fees, cash drag, and residuals. A manager may own winning names within sectors but be underweight the strongest sectors overall. For instance, strong stock picking in utilities may not offset being underweight technology during a tech rally. I would bridge portfolio return to benchmark return, show each effect, and explain whether the issue was positioning, implementation, or market exposure. Be sure to mention that positive security selection can be outweighed by poor allocation, currency, cash, or fees. Show how you would diagnose the issue using a bridge from benchmark to portfolio return. Question 5. How would you reconcile attribution results to official performance returns? My first step is reconciliation, because attribution is only useful if the totals are right. I would compare official performance, accounting returns, benchmark returns, and attribution output at portfolio and segment level. Then I would investigate price differences, corporate actions, missing holdings, stale FX rates, accrued income, fees, and benchmark mapping. Once the residual is within tolerance, I can trust the attribution story rather than explaining noise. While answering, focus on reconciliation discipline. Official returns, attribution totals, benchmark data, holdings, prices, FX, income, corporate actions, and tolerance thresholds. Emphasize that analysis is unreliable until totals tie. Question 6. How does multi-currency attribution work? Multi-currency attribution separates local asset performance from exchange rate impact. I would identify the portfolio's base currency, the benchmark currency treatment, and whether hedges are included in the portfolio or shown separately. A foreign equity can rise in local terms but hurt a dollar investor if its currency weakens. Good attribution should distinguish local selection, country allocation, currency translation, and hedge effectiveness so the PM sees the true source of return. Make sure to cover local return, currency translation, base currency, hedging treatment, country allocation, and benchmark currency assumptions. A strong answer separates investment selection from FX effects. Question 7. How is fixed income attribution different from equity attribution? Fixed income attribution is different because bond returns are driven by rates, curve movement, carry, roll down, spread changes, credit selection, and currency. I would not rely only on sector allocation and selection. For a corporate bond portfolio, widening credit spreads can overwhelm coupon income, while duration positioning may help if rates fall. The interview answer should show that I understand both the risk factors and the data complexity behind them. In your answer, talk about why fixed income attribution differs from equity attribution. Include duration, curve, carry, roll down, spread, credit selection, sector allocation, currency, and the importance of clean security level data. Question 8. Why is benchmark selection so important in attribution analysis? Benchmark selection drives the whole attribution result. I would ask whether the benchmark reflects the mandate, investable universe, currency, constraints, and risk profile. If a global equity portfolio is compared with a domestic index, attribution may falsely label structural exposures as active bets. I would also check custom benchmarks, blended weights, rebalancing rules, and constituent data. A poor benchmark creates a misleading performance narrative even when calculations are technically correct. Be sure to mention that benchmark choice shapes every attribution conclusion. Discuss mandate fit, investability, constraints, currency, custom benchmarks, rebalancing rules, and the risk of misleading active bets. Question 9. What is factor attribution and how is it different from holdings-based attribution? Factor attribution explains performance through systematic exposures rather than only sectors or securities. In equities, common factors include value, momentum, quality, size, beta, industry, and country. I would use it to see whether alpha came from stock-specific skill or from being tilted toward rewarded factors. For example, a value manager may outperform because value rallied, not because individual stock selection was exceptional. That distinction matters for risk review and manager evaluation. While answering, focus on systematic drivers such as value, momentum, quality, size, beta, industry, and country. Explain how factor attribution separates manager skill from rewarded or unintended exposures. Question 10. What data quality checks would you perform before publishing attribution reports? I would validate data before interpreting output. Core checks include beginning and ending market values, cash flows, holdings, prices, FX rates, accrued income, corporate actions, benchmark constituents, and security classifications. I would compare attribution totals against official performance and review large contributors for reasonableness. If one small position explains a huge effect, I would suspect a price, mapping, or weight issue before calling it genuine alpha. Make sure to cover practical data validation. Market values, holdings, prices, FX, cash flows, accrued income, corporate actions, classifications, benchmark constituents, and reasonableness checks on large attribution contributors. Question 11. How do external cash flows affect performance attribution? Performance attribution usually works from time-weighted returns because the goal is to assess investment decisions, not the timing of external client flows. Large subscriptions or redemptions can distort money-weighted results. I would ensure cash flows are dated correctly, portfolios are valued around material flows, and cash is treated consistently versus the benchmark. Cash can create active return, especially in volatile markets, so it should not be ignored or buried. In your answer, talk about why time-weighted returns are typically used, how external cash flows can distort analysis, and why cash allocation must be treated consistently against the benchmark. Question 12. How should derivatives be handled in attribution analysis? Derivatives should be attributed based on their economic exposure, not just their small market value. An index future may represent a large equity beta position with limited cash posted as margin. I would confirm notional exposure, delta adjustment, underlying classification, currency, and benchmark treatment. For options, Greeks and nonlinear payoff matter. If derivatives are mapped incorrectly, allocation and selection effects can be badly understated or assigned to cash. Be sure to mention notional exposure, delta adjustment, underlying mapping, futures, options, swaps, margin cash, and benchmark treatment. The key point is economic exposure, not accounting market value. Question 13. How would you present attribution results to a portfolio manager after a weak quarter? I would keep the discussion commercial and evidence-based. First, I would state the active return and the largest positive and negative drivers. Then I would separate intentional bets from unintended exposures using clear exhibits by sector, security, country, factor, or curve bucket. I would avoid drowning the PM in formulas. The best report answers 3 questions: what happened, why it happened, and whether it matches the investment process. While answering, focus on communication, summarize active return, highlight top contributors and detractors, distinguish intentional bets from noise, and tailor the level of detail to portfolio managers or clients. Question 14. What is residual or unexplained return in attribution? And how would you investigate it? A residual is the part of return not explained by the attribution model or data setup. I would not ignore it because a large residual undermines confidence. Causes include timing differences, transaction costs, fees, pricing sources, corporate actions, rounding, derivatives, and model limitations. My approach is to quantify it, compare it with tolerance, trace it by segment or date, and decide whether to correct data or disclose the limitation. Make sure to cover what residual means, why it matters, typical causes, tolerance thresholds, investigation steps, and when you would correct the data versus disclose a model limitation. Question 15. What technical tools are useful for a performance attribution analyst? Tools matter because attribution roles are data-heavy. I would be comfortable using Excel for review packs and pivots, SQL for extracting holdings, returns, and benchmark data, and Python or similar tools for automation, validation, and large reconciliations. The key is not naming software. It is showing control over data lineage, repeatable processes, exception handling, and auditability. Strong technical skills reduce manual errors and free time for interpretation. In your answer, talk about Excel, SQL, Python, reporting platforms, automation, data lineage, exception handling, and auditability. Emphasize that technical skills support better controls and clearer analysis. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.